Day trading. Most beginners lose money in year one. Want to survive? Here's the plan.
70 to 85% of retail day traders lose money in their first year. That's not a clickbait number. It's the academic base rate, repeated across published studies in Brazil, Taiwan, and US discount brokerages. Day trading isn't impossible, but the entry curve is brutal. The realistic timeline to consistent profit is 12 to 24 months, and the traders who survive year one almost always have one thing in common: a specific number written down, enforced before the market opens. I'll get to it, but first you need to pick a market, because that one decision matters more than which broker you use or which indicator you favor. A day trade is buying and selling the same instrument inside the same session, flat at the close, nothing held overnight. That definition matters because it determines which regulations apply to you, and the biggest one is the FINRA Pattern Day Trader rule, the $25,000 wall for US equity traders. 3 realistic markets for a beginner. US equities, the deepest liquidity on earth, zero commission trading, a predictable 9:30 to 4 p.m. session. Brokers like Interactive Brokers, Schwab, Fidelity, Webull, but you need $25,000 in your margin account to day trade them freely. CME Micro Futures, MES on the S&P, MNQ on the NASDAQ, MGC on gold, MCL on crude. Start with $500 to $2,000. No PDT rule. 23-hour sessions Sunday through Friday. Platforms like TradeStation, NinjaTrader, IBKR. And major pair forex, Euro USD, GBP USD, USD JPY. Traded 24 hours a day, 5 days a week. Start with $200 to $1,000. Sub-pip spreads at ECN brokers like Pepperstone, IC Markets, OANDA, also outside PDT. So the question isn't which market is best in the abstract, it's which market matches the capital you actually have. About that $25,000 wall, FINRA Rule 4210, the Pattern Day Trader rule, is the single most common roadblock for new US day traders. Mechanics in one sentence: place 4 or more day trades in a rolling 5 business day window in a margin account and you're flagged. $25,000 minimum equity to keep trading. 3 routes around it. 1. Hit the 25K floor and stay above it. Your buying power becomes 4 to 1 intraday, 2 to 1 overnight. 2. Use a cash account instead of margin. You lose short selling and you can only trade with settled cash, but the PDT cap disappears. 3. Trade outside US equities entirely. Futures and forex don't care. Here's the part most beginners miss. The PDT rule isn't punishing you, it's a tripwire. The regulator's bet is that anyone day trading a sub 25K account is statistically going to lose, and the data backs that bet. So if you're hitting the wall, it's not your enemy. It's a signal that your capital and your ambition aren't lined up yet. Okay, market picked, regulation understood. Now the part that actually decides survival. Before you fund anything with real money, you paper trade. 4 to 8 weeks minimum. Webull, TradingView, ThinkOrSwim, IBKR all offer free paper trading. The goal isn't to practice in some abstract sense. It's to build a written plan against a live market while you're still wrong about everything. And early on, you will be wrong about a lot. While you're paper trading, you're also writing the rules you'll trade with. 1 page. Entry criteria, stop loss rules, position size formula, daily loss cap, daily trade cap. If you can't write the plan down, you don't have a plan. The toolkit is smaller than the YouTube ecosystem suggests. A broker platform, TradingView for charting, FinViz for scanning, a journal, a Google Sheet works fine, or something structured like Edgewonk or TraderView, a news feed from your broker. That's it. You don't need a $300 a month chat room. You don't need a Bloomberg terminal. You need the discipline to use the free tools every single day. Now the risk framework, the number I mentioned at the top. 1% of equity at risk per trade. 3% daily loss cap. 3 to 5 trades a day maximum. Stop trading for the week after 2 red days in a row. Stop trading for the month after a 10% drawdown. The arithmetic. On a $10,000 account, 1% is $100 of risk per trade. If your stop is 50 cents below entry on a stock, that lets you size 200 shares. On a $30,000 account, 1% is $300 of risk. Same math, bigger position. Here's why this framework actually works. It's not the specific percentages, it's the fact that they exist in writing before the session starts. The traders who blow up don't blow up on one bad trade. They blow up on the trade after the bad trade. Loss, frustration, doubled size, second loss, panic, tripled size, and the account is at 60% of its starting value before lunch. This is revenge trading. The math is brutal. A doubled position after a normal loss takes a $10,000 account to $9,000 in 30 minutes. 2 of those and and you're at $8,100. 3 and you're playing catch up with shrunken capital, which forces even bigger positions to recover. It's a death spiral. The opposite habit, having your size after a loss, going back to plan, feels wrong in the moment. It's also the single behavior that correlates with surviving year 1. Same logic applies to the other account killers. Holding a losing position overnight to avoid taking the loss. Trading penny stocks with leverage. Following chat room calls instead of a written plan. Each one has the same fingerprint. Emotional response in place of a rule. The framework removes the emotion by deciding everything in advance. Now setup selection. 1 setup, not 15. For US equities, the cleanest beginner setup is the opening range breakout. Mark the high and low of the first 15 to 30 minutes after the open. Trade a breakout of either side, stop on the opposite side. Win rate is moderate, 40 to 55%, but the risk to reward is favorable when it works. For futures, the VWAP pullback. The volume-weighted average price acts as a magnet during trend days, and you wait for price to pull back to it and bounce. For forex, the London open breakout. Wait for the London session, mark the range from the prior Asian session, trade the break. Whatever you pick, trade it exclusively for 100 trades before you look at a second one, and journal every single one. Setup, reasoning, entry, stop, target, outcome, a screenshot. After about 100 entries, patterns emerge, in the market and in your own mistakes. The journal isn't homework, it's how the edge develops. So when do you actually go live? 3 preconditions, non-negotiable. 1. At least 100 paper trades on your one chosen setup with a written record of each. 2. A break-even or profitable expectancy on those trades. Not necessarily a profit, but not a clearly losing edge either. 3. The written risk framework. 1% per trade, 3% daily cap, 2 red day stop. Defined before you open the live account, not invented during a drawdown. Going live before all 3 is gambling. Going live after all 3 is still hard because real money changes execution and the emotional load is different. But the structural foundation is in place. And when you do fund the account, start with the smallest position size the broker will allow. The goal in month 1 isn't to make money. It's to test whether your paper process survives real risk. So, the honest verdict. Day trading is a real profession with a hostile entry curve. Plan for the first 6 to 12 months as a paid education, not a salary. Pick one market that fits your capital. Equities if you have $25,000, micro futures if you have $500 to $2,000, forex if you have $200 to $1,000. One setup, 100 paper trades before a single live one, and the 3% daily loss cap. That's the number I mentioned at the top, the one that separates the traders who survive year 1 from the ones who don't. Journal everything, size small. That's the path with the best base rate of survival. And in year 1, survival is the entire game.
1 market, 1 setup, 100 paper trades, 3% daily cap. Full breakdown linked in the description.